Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. I'm Elise Blink. Here's today's daily update. Do you know what mortgage fraud is? You may not, and you may be committing it without having any idea. Today's guest has some information about that, and there's good news and bad news associated with what's going on with mortgage fraud today. The good news first, appraisal fraud has been curtailed somewhat in recent years thanks to some government regulation. The bad news is that occupancy application fraud is on the rise. Tim Coyle is the Senior Director of Financial Services and Global Real Estate for the Risk Solutions business of LexisNexis. And he's got numbers on why banks still have their work cut out for them when it comes to occupancy mortgage fraud. And I want to define for you exactly what that is. Tim, welcome to Big Money Real Estate.
Hey, Elise, thanks for having me on the show.
Sure. Let's start with a big definition. Tell us what happens when mortgage occupancy fraud happens.
Sure. Occupancy fraud is generally when you are trying to take ownership of a home. You're trying to, a lot of times what we'll call it is you've got fraud for housing or fraud for occupancy, and you also have fraud for profit. A lot of times this is classified fraud for occupancy. And what that means is you generally don't intend to default on that loan, but because it's a second home or investment property, obviously the risk could go up there as well. So let me kind of just define it for you if I can just
Please.
take a minute. So you've got, when you're taking a loan application, when you're doing a Fannie Mae 1003, which is a loan application, you're sitting down with your loan officer and they're asking you, is this a primary residence? They're asking you if it's three types. Is it a primary residence, number one? Is it a second home or an investment property? At the second that you sign a document and you have on there that this is a primary residence and you intend to have this as an investment property, you have now committed mortgage fraud.
All right.
At that time.
So let me jump in and say to people that if you read the documents carefully, what you say when you sign this, I believe it still says this, that you intend to live in it or you will live in it for 1 year from the date of closing, or you have the intention to live in it. Is that correct still?
Correct. You will live in that house, you'll occupy it 60 to 90 days after, and you'll live in that house for 1 year.
Right. Although there is,
even at that point in time, if you do occupy that house, and let's say it's 8 to 9 months down the road, and you want to put it in investment property, make it an investment property, you should at that point in time call up your lender and let them know what's your intent, because you're really at that point in time you're breaking your contract with that lender.
right. Whereas if you let it go to 1 year, you would not be.
Correct.
Right.
Because that's what you're signing for. So again. And go ahead, sorry, Lise.
Well, what I was going to say, just to be really clear for everybody watching, it's this intention to occupy it. If you close on the home and suddenly about 2 minutes after you close on the home, your company transfers you surprisingly to, say, San Francisco, and you're supposed to be living in Ohio, right. The intention is still there. But if you go into this property thinking to yourself, I already live in a beautiful house and I'm going to buy this 6 miles away, and I know I'm going to be renting this property out, whether it's a house or a condo or whatever it is, that's occupancy fraud. If you have Correct. Signed the mortgage as an owner-occupied unit, but you fully intend to just rent it out from day one. Correct.
Absolutely.
What percentage of people are doing that?
So on Fannie Mae's recent file that we just looked at, they had a 19% of all mortgage fraud was occupancy fraud. But the problem with that is, and I think at the beginning of this, you alluded to a few of these of appraisal fraud going down. But the problem with occupancy fraud is it's on the rise. A lot of fraud is going down right now. It's decreasing. And the regulators have done a great job in some areas. So if you kind of look at what happened with Dodd-Frank and call it post-crash 2007, what happened was they put in a lot of new regulations. And a lot of that was for, if you remember, appraisal fraud was big time. Sure. It was pervasive. What used to happen was a loan officer would order the appraiser. The loan officer would order the appraisal. And that's a conflict of interest because the loan officer has a lot to gain from that appraisal coming back at the right price, correct?
Absolutely.
So what happens is, in that instance, what they did is in 2010, they mandated that you must now use an appraisal management company. A loan officer is no longer allowed to order your appraisal, nor is the loan officer allowed to discuss your appraisal with the appraiser. It has to be run through an appraisal management company, which is a third-party vendor, and generally they have a round robin of lots of different appraisers on staff. That was a great rule. They got that right. They really did. I mean, I think it was fantastic. Very similar to what they did with the 4506 on the 4506T on the income documentation. If you remember, another law that I believe they got right was people would go out and sign a 4506 form when you do a loan. If anybody's gotten a loan recently, you're familiar with this. It gives the lender the right to go and pull your income statements from the IRS, right, and your tax transcripts, so they can see exactly what you're making. So if you say I made $40,000 last year, and in fact you made $20,000, well, if you pull a 4506T, I mean, if you pull by signing the 4506T, if you pull that through the IRS, you can validate that. Okay. What they used to do is, before a lot of this regulation went in, you would just sign a 4506. And nobody would actually validate it. Nobody actually would pull that form.
Yeah,
okay.
The verifications were a little bit lacking, shall we say?
Well, and that's exactly what I'm going at. So if you look at what's being done today, somebody's basically kind of like what I equate to as the old 4506. You just said, hey, I make $100,000 and I'm in a first level job that's making really 20, but I just signed it and they took my word for it.
Right.
Okay.
Stated income.
That was the old way. And then once they actually started validating and pulling those transcripts, you could obviously see fraud or some sort of misrepresentation. Maybe the person got it wrong, but at least you could actually validate whether or not that was true. Similar to with occupancy, if you say, hey, my intent is to occupy this house as my primary residence, and to your point, I've got a 5-bedroom, 4-bath home 5 miles from this condo property that is 1/5 the price. One, that doesn't add up, but then I sign something and say, no, that's what I intend to do. Well, if you don't go back in and pull something 90 days later to make sure that person's occupying that property, you're really failing at your job. I mean, you've got to go back and do that. You have to go back and make sure that these people are in fact moving into their house. So, otherwise, you're putting more risk on your books by allowing somebody to have a second home or an investment property on the bank's books that normally wouldn't be there. They'd be a primary residence. And,
right.
and if they were investment or second, they would require more money down and a higher interest rate to in fact really to go hand in hand with the amount of risk that you're
right.
taking. So again, it might be 50 basis points, it might be 100 basis points, but it is more when you get an investment property or a second home.
All right, so that of course is exactly why people do this. They feel like the risk reward is much greater. So if you buy an investment property, typically you're still required to put down between 25 and 35% in cash. Long gone are the days of zero down, nothing down, all that kind of baloney, to
Absolutely.
Put a nice word on, right? I'm not sure that was ever really true, but and then on top of that, you're paying extra fees. Usually you may be paying as much as 5% in fees, 3 to 5%, and then on top of that, your interest rate is going to be a half a point to a point higher, depending on what your credit score looks like. And so
Correct.
That's a significant amount of cash for an investment property over and above what you were doing before. And people who have, like the big hedge funds who have all come in, they're buying with cash. They have a lot of cash out there that's earning zero. They're plugging it in here, and if they get a 5 or an 8 or a 10% return, they're doing much better than having cash sitting in a bank. But for the average, let's say less flush investor,
right. Sure.
They have to actually get a mortgage on that, and it's a lot cheaper to get a mortgage with 3% down at 3.5%, 4%. Than it is to put 35% down, which you may not even have. On top of that, you have to have more cash in the bank, and then all the rest as it goes along. So it's easy to understand why you might see 36% higher occupancy fraud than you did the last time anybody looked.
Right. And again, there's no real checks in place. There's no one consistent methodology that's in place today to check for occupancy fraud.
Well, how are they doing it now? What are they doing? Are they knocking on doors?
So that's actually a great question. It's a very, very expensive one. Refinance right now, the probably the best process is to go knock in the traditional sources is to go knock on a door and find out if that person really is living there or not. But that's very, very expensive. I mean, that can be anywhere from $100 to $250 to have somebody go knock on your door. Also, do you really want some person knocking on your door? And with all of the
Yeah, that doesn't work too well when the lenders have gone knocking on people's doors trying to get them to answer their phone or open their mail or, answer the door. Nobody wants to do that to a lender.
Right, and how do you even know? I mean, how does this third party really even know who Tim Coyle is?
There's no way to know.
Tim Coyle could be my son or my brother or my whoever, my uncle that's living there.
So what are they doing? Are they checking? I guess they could check tax records. They could check against driver's licenses to see if that's switched. What are they doing?
Absolutely, and again, with the cost of compliance being so high right now, the banks and the mortgage companies are trying to do everything they possibly can to really comply with all the new regulation out there and with Dodd-Frank. I really think everybody's trying to do everything they can. Unfortunately, right now, you don't have, well, I should say up until now, you don't really have one single source, one consistent methodology. Somebody might use motor vehicle registrations. Somebody might use DMV records. Somebody else, to your point, might use tax assessors. But again, unless you can pull all of that to one, which is, the product that we just came out with here at LexisNexis Risk Solutions is a new verification of occupancy that kind of brings all of those dimensions, brings 16 different dimensions into one. And you can look at, it's consistent. And you can look at, 16 different dimensions of that person to see if that person does occupy that house or not. And if they don't, it actually will let you know who actually is occupying it as well.
That's so interesting. So what are some of the things that you look at of the 16?
Well, and again, I mean, just some of them I could probably mention is motor vehicle, utilities, tax assessor, right. DMV records. As you know, here at Lexis, we have, billions of...
You have lots of information on all of us. I know, you're like a credit reporting bureau. You have lots and lots of details.
we certainly do. And, we certainly hope that we're using that to stop fraud, to put an end to fraud.
Right.
That's really what we're in the business to do. So when the lenders kind of came to us with their problem this past year and a half is, hey, we just don't have a way to really check for occupancy. We want to stop it. We'd like to stop it. Could you help us stop it? So that's when we actually said, yes, let us look at this. Let's look into it. And we built this product called Verification of Occupancy that brings all those together and it scores it out. So it'll be anywhere from a 0 to a 90, kind of help that lender identify whether or not that person does occupy that property.
How accurate is it, do you think?
Well,
I mean, I'm sure you've tested it.
So we did one recent side-by-side study on 7,000 loans of good knowns and good bads. Okay, the traditional way, and it was a side-by-side study with a very large financial institution that I can't obviously name their name, but a very large financial institution doing a side-by-side study on 7,000 loans. We were able to predict 2.6 times the amount of mortgage fraud on that file that they were using this new occupancy fraud product that we've come up with.
That's pretty significant, I would think, because what are they normally able to do it? I mean, it seems like that they would have the ability to catch a very small percentage of this.
Yeah, and that's, in this study, they had 113 records that they were able to, and we were 290, again, which is about 2.6 times the amount.
Right. But still a fraction of what it actually is.
Oh, yeah, and then, well, on top of that, that's of true confirmed mortgage fraud. So,
okay.
Not all, most of the 7,000 records were good. I mean, you hope out of somebody's portfolio that most of it is good. So, but we were able to find that extra, 2.6 times the amount of mortgage fraud, which ultimately came back to $40 million in unnecessary repurchase demands that would be pushed back on that lender.
So let's be really clear what happens here. So if you commit mortgage occupancy fraud, so in other words, you buy this property and you have no intention of living there, which is a burden of proof, and you've rented it out, and the lender comes back, they can call your loan. I mean, that's what happens. They could call your loan. They could press charges against you and go even more, which would be, I think, kind of dumb because then nobody's paying the mortgage. But that's another, I mean, fraud is fraud, and there
Yep.
could be some legal options against you as well if you're committing that.
Well, and again, if they call that note due and nobody can get another loan at that point because they didn't have the true 30%, guess what's going to happen?
Right. That
They're going to get foreclosed on, and now all of a sudden you're going to have a foreclosure on your record. So even if they don't press charges on you, you're now going to have a foreclosure that was unexpected. And you could have had an investor in there, and it could be paying on time. I think, Elise, I think you bring up a great scenario that a lot of people don't think about, and that is most people think that the only time I can get in trouble for fraud is if it goes bad.
Right.
That's not the case here.
It's not the case, but I can't imagine lenders really want, 20% of their loan portfolio going into foreclosure simply because these people didn't, committed loan occupancy fraud. There has to be another remedy for them. I'm not sure whether that's buying another title policy, if that's getting more money put down, getting more of the loan paid off. There has to be some sort of other remedy than taking 20% of your portfolio into foreclosure.
Well, and
that just isn't smart anyway.
Right, and don't forget, when I gave, let me make sure I clarify, on the 20% of all, when the Fannie Mae study is 20% of all mortgage fraud is occupancy fraud. So it wouldn't be that, it wouldn't be representative.
Okay,
that
so
much of
that's better because I'm thinking, that's a lot of mortgage fraud.
No, but to your point on that 7,000 portfolio study that we conducted, I mean, you were still talking about $60 million of occupancy fraud on a 7,000 loan portfolio.
It's
so
not
that's
a small
still
number.
A ton of money. I mean, enough to really put anybody in jeopardy, especially any sort of bank. So it's a large problem. And again, I'd say the biggest concern that I have about occupancy fraud is that why I think we've done a great job with some of the appraisals, some of the income docs, again, that I've mentioned before. This is the one that's up. I mean, it's up 36% from 2011 to now, to 2014. It's up 36%.
Well, rising 36% is huge. And I'm trying to think if this is because the investors who are doing this, that they are, and we're not talking about somebody who buys the house and then a month into it, they get transferred somewhere else.
Sure.
That's, no bank is going to call you on that. Again, this
Right.
is about intent. So they have to prove you never intended to live there.
Right.
But,
and generally on that one, the lender would probably just ask that borrower to get a transfer, some information from his or her company, stating that person's being relocated, and that company would be happy to comply. And generally at that point in time too, the person would usually put their house on the market, and you could actually pull an MLS to confirm that person is selling that, and that is true. But lenders aren't looking to stick it to people, and but they are looking to, and we are looking to put an end to fraud.
Right, which is so interesting. Tim, this has been really insightful, and I appreciate it, and I hope you'll come back and we'll talk about some other kinds of real estate mortgage fraud that are out there.
Yeah, Elise, as always, thanks for having us on the show. We appreciate it.
All right, Tim Coyle is the Senior Director of Financial Services and Global Real Estate for LexisNexis. We so appreciate his time, and thank you for watching this episode of Big Money Real Estate. You can send me your investing questions on Twitter and Facebook. Please share this video all around with your fellow investors. As you can tell, this is one of the most important topics that we're going to talk about. You do not want to get caught with mortgage fraud, and there are new ways to catch you every time. I hate to say it. Don't forget to check out my new series, The Intentional Investor, How to Be Wildly Successful in Real Estate, and you can find that at the WIT Nation store or at thinklingstore.com. I'll see you next time. I'm Elise Glink.